Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and we have a very special show for you this afternoon. Jess and I are going to have a much more live interactive discussion on today's market, what we're currently seeing, what opportunities we see, and just what adaptations we are making to trade in this more volatile market. And this is going to be a discussion between Jess and I, and also with you as the audience. So please feel free to chime in the chat window as we go along with your comments, your questions. We'll try to address them as we go along instead of our usual Q&A format that we do at the very end. So changing things up a little bit, but hopefully you guys will enjoy this show. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the securities that we will discuss during today's session. And Jess, we have a very action-packed agenda today. We will cover a lot of different things, but I will try to keep us on target and discuss all of these things. But we're going to go over first just a macro overview of the broader markets and kind of how we're thinking about volatility in this market and what adjustments we might be making with respect to trading. We'll talk a little bit about day trading options, something that we usually don't talk about, short dated options, kind of looking at very short dated options versus longer dated options. What's the difference? What risks, what rewards are there available? We'll talk a little bit about the retail landscape, what has changed here over the past couple of days, and how that might influence our views for trading opportunities going forward. So Jess, what I'd like to do is I'd like to kick this off by just talking a little bit about the broader markets, your views on the current market volatility and whether, when you're looking at a market like this, are you looking for further downside or are you more contrarian looking at this volatility and the sell-off as a buying opportunity? Let's start there.
Yeah, so excited to have this conversation. So we've had a lot of debate and Tony and I actually talk about this quite a bit. So we just decided to talk about it in front of you, and we have for years. So what I'm looking for is I love the Dow theory, and I reference that a lot. So when I'm looking for a trend reversal or what the market is doing, I look for a period of consolidation and a validation of strength on support levels. So when I did do CNBC last week, that was a support level that I called out, or what I called out in that minute time frame is that support zone between the Fibonacci replacement levels of 38.4804 and 40.37. And it's actually doing that. Like the support was hit relatively close today. So I want to see that continue to support in order to understand if this is a bottom. So that's what I'm looking for. And then when there are periods of consolidations, or if I'm looking for that reversal, or if it's a bear market or even a bull market, there's going to be little rallies in between. So we'll capitalize and trade on that. From a technical market view, though, that's what I'm looking for, is validation of that support zone, and for it to either retain in that support zone, test those levels and completely break through, which would be a more bearish view. And then I would look for my next support zone, or just pushing through that support, or excuse me, that support zone, and then as a resistance level, and then that's it. So I'm looking for those two levels to be tested and validated before I decide which direction the market's going to do. And I need a period of consolidation first.
And let's just repeat, what levels were those again on the SPX?
38.4804 and 40.37.
38.404,
Mm-hmm.
which is about right there. And what was the other one?
It was 40.37.
4037.
You got it.
So right now we're trading right in between those two ranges on the S&P, or those two levels, right? You're looking for 38.03 or 38.04 to hold as support, and you're looking for 40.35 on the resistance level. And if it breaks out above that, you would say that we're back into buying territory. Is that correct?
Almost. So that's actually my support zone. So I want to see it to actually, that's those both my support levels. So the bottom support level and then the upper support level.
Got it. What about volatility, right? We look at VIX here right now. It's currently trading. Actually, we closed below the 30 handle here today. What's your view there in terms of volatility and how that affects your view of the broader markets?
Yeah. So, that VIX index is a view of 30 days. So it's forward looking. And I think that's a common misconception that I like to talk about when you're looking at that index. So it's a future look at volatility on the market. So there was something that came up on, was a couple days ago, where there was a discussion about the markets being down, but then the VIX also being down, or so the correlation didn't exist. And let's do that forward looking. So not necessarily, we haven't hit high levels on the VIX for me to be super concerned yet, if that makes sense.
Yeah, so that's my view here. When you look at the market, and there's certainly concerns of further downside, and a day like yesterday, I think, is a scary day when you see major mega cap stocks down anywhere from 12 to 25% on the back of what is terrible news from an earnings perspective. It really rocks your confidence, if you will, in saying that these are potentially buying opportunities and that there's likely a limited further downside. But when you look at the VIX and you look at the fact that we've had consecutive days, back to back to the downside here on SPX, but VIX hasn't moved any higher, and in conjunction actually moved lower. This is typically the behavior that we see towards a market bottom. And we can look at, while this sell-off is not anywhere near what we saw during the March 2020 pandemic bottoms, but one of the things you'll notice here is that towards the bottom of the market during the pandemic, what we saw here was the VIX was actually declining while the S&P was declining. And if you look at the last 5 days of the SPX during the pandemic lows, what you saw was a conjunction of VIX moving lower and SPX moving lower. Those two things moving in conjunction typically are inversely correlated, meaning when SPX is moving lower, VIX is moving higher. But when you see the two move in conjunction, where the markets are moving lower, but the volatility is also moving lower, that is usually a sign that there's some form of a bottom that we have found here in the broader market. So this is really something I think is worth paying attention to here in the market. And that's why, at least for me, this volatility is more of an opportunity rather than something to be necessarily scared of per se, that there's going to be further downside. That's my take on the broader markets. I don't know what your views are in terms of capitulation and things like that.
Yeah, I think it's interesting, and I like to broaden it a little bit, and we talked about this a little bit earlier as well, but as far as the more of the economic impacts on the market right now, so interest rates, inflation, and the labor market, as well as geopolitical risks. So that's something that I think is of concern. So today, the job report was released this morning, and that's a really great piece of information. Apologize, my phone is ringing. Got a phone call. I am so sorry, everyone. I had to turn that off. I normally put my phone on Do Not Disturb, and that one got that. Anyway, so with a tight labor market, though, so that's something that the Fed is talking about with those minutes. They are saying that they want to have a soft landing when they're raising interest rates. And the way that I love to describe when the Fed will raise interest rates, and I did this pre-pandemic, mind you, is whenever you do something like that, when you're raising interest rates, you are taking money away from the consumer. It's a type of tightening on monetary policy. And you're doing that to battle inflation because you're less likely to borrow, you're less likely to spend money because it's more expensive to do that. But you're not going to do that to a consumer unless there's a healthy environment, and that's essential for a soft landing. So that's why we're looking at those events. And when there is a volatile market like that, I think it's important to pay attention to those dates where, like we do earnings, when we know something's going to happen, like job reports today. So there is a tight labor market. The Fed said earlier this week that they want to make sure that that cools off. So when they feel like they can have a cooling off labor market without high unemployment, because vacancies are coming off from retirement and companies are only laying off if they have to, which isn't too much. So I think it's interesting and something to watch, but I think more of the inflationary concerns is something that is interesting from a macro view. And then we'll talk about that a little bit later when we talk about stocks that really can outperform that, or their impact on the actual securities themselves.
So I do want to address this macro comment that you just made, as well as kind of the interest rate comment, as far as raising interest rates is done to temper inflation. You know, we just saw retail sales come out a couple of days ago that was actually quite strong. You know, does that concern you that the consumer is not really slowing down despite rising interest rates?
I think it helps, right? So the Fed said that they can control one aspect of it, right? And so that's just proof of that aspect, if that makes sense. So I think it actually helps with the soft landing. You do want the consumer to spend. That's important. That's how earnings go up. So that's important. It's almost like a chess game that they have to play. So I want a really healthy consumer, which means they could handle the rise in interest rates. And if they can handle the rise in interest rates and earnings can still go up, then the market can go up subsequently. And that's extremely important in this type of environment.
Thank you so much. And, you know, we actually have a couple of comments here, and one question, or a couple of questions rather. Clayton's asking, well, you know, you talk about you looking for a consolidation before feeling confident in kind of being a contrarian and buying into this market. Clayton's asking, how long of a period of consolidation are you typically looking for in this type of
market? So there's no predefined set period, Clay. It's testing those support levels and those resistance levels, and that will indicate a stronger trend. So it's really just, what trend is the market in? Is it going to be in a period of consolidation for, I'm not sure how long, but it's how strong is that consolidation. So if it tests that support zone that Tony has outlined on the screen, that's going to give me an indication that support zone is really, really strong. And anytime, almost like a ball bouncing from ceiling to floor, anytime that I see the S&P or security that I'm charting hit that support zone, then that's going to give me a great indication that it should buy, because it's just following the trend and the pattern recognition that technical analysis tells us. And same with the resistance level. So I would just be looking for the strength there. The more strength it has, the more I can capitalize on those movements. And then when it tests it, I'll go from there. So it's not necessarily a timing per se. It's just the strength of those zones that are created.
Right. There is a question about capitulation and kind of what capitulation means. I'll discuss this a little bit, but capitulation is really just the point at which markets become exhausted, that they start to turn around, right? Basically, when this is the pandemic sell-off, obviously, that we're all sort of at this point familiar with, the capitulation is referring to when there are no more sellers in the market. You know, during this pandemic, everyone's a seller. That's why we have such a fast, violent decline in price of just about every single asset class. You know, during that month or so, capitulation is referring to the point at which there are no more sellers. No one is. Everyone has sold off what they wanted to sell, and that there's only buyers left. And capitulation could work in both forms. You know, you can have capitulation in to the upside here as well. You could argue that, you know, some of the names like GameStop and AMC certainly went through a capitulation here to the upside, where there's no more buyers. You have a large amount of buyers stepping in a short period of time. There's almost a panic, if you will, in either buying or selling. And at some point, those buyers or sellers are exhausted. There are no more buyers. And that point at which that happens is what we refer to as capitulation. And there's always the question of, how do you measure capitulation? And one of the ways that I have found reliably to do so is really around volatility. We tend to see that volatility will peak before the market actually reaches that final bottom. Many times, is one way to measure capitulation. So hopefully that kind of answers your question here. Great. You know, for those of you that are sending in your comments, your questions, keep them coming in. We'll try to answer as many of these live as we go along.
Hey, I hope that you're enjoying the session so far. I would love for you to join me on my next live event, where you can learn alongside thousands of traders, and I'll answer your questions live. Either click on the link on your screen or check out the description below. I host weekly trading and education sessions just like this one, and you'll get to trade alongside our research team's daily trading signals, weekly technical research, and access the most intuitive option strategies analytics platform free for 30 days. We're here to help you succeed, and please make sure you like this video and hit the subscribe button. Thank you, and let's get back to it.
So let's move on to what we want to discuss next, Jess. And you and I attended a conference here last week, and something that really was illuminating for I think both of us is really just how the sheer amount of volume that is traded in what we would consider short-dated options that expire in less than 2 weeks. If we looked at this data 3 years ago, before the pandemic, you would see that about 50% of all volume is traded in roughly 45-day options or shorter. What we have seen here over the past couple of years, or at least over the past quarter, is that 50% of the trading volume is traded in options that expire in less than 10 days. And this is prior to this, this is data that is prior to the sell-off. It's not just because of the current market volatility that we're in that traders are gravitating towards shorter dated options. It's really just the shift that we've seen in retail traders that are trading these shorter dated options. So I want to take a little bit of time today and discuss these shorter dated options, the pros and cons, and really dive into them, because whether or not we trade them, whether or not we agree with them, traders are trading them. And I think it's worth paying attention to. So first, I just want to get your take on trading shorter dated options. Do you ever do them? If you do, kind of when do you use these types of strategies?
Yeah. So yesterday was a great day when that happened. There was a big down day in the market. And when that happens, there's a spike in implied volatility on the put side. So from a short-term perspective, and since there is a lot of movement in the market, I would capitalize on that implied volatility and perhaps sell some credit spreads on put credit spreads on stocks that I feel like could have some potential to be on the upward side, but they are definitely right where they need to. They could either be sideways or go upwards, but I want to capitalize on that implied volatility at that time. And that's the only time that I would do something very short dated, is I'm expecting an implied volatility crush of some sort and capitalizing on it.
Could you give us an example of, what type of strategy you would use in such short dated options? Are you selling a naked call or put? Are you selling a credit spread? What kind of strategies are you using when you're talking about taking advantage of this elevated implied volatility from yesterday's move using a short dated option?
Yeah, I'll do a credit spread. I don't want to do anything naked because it's a high volatile environment. So I would be exposing myself to unlimited risk on the call side or substantial risk on the put side. So therefore, I do a 10 or a 12 point spread. But this yesterday was a lot of put spreads. There were a couple of calls, but I did trade yesterday more than often.
I will say that, and probably you'll tell me that this is a dumb idea, but yes, the days like yesterday are the days that I tend to sell some of the more naked type strategies, like a short strangle on those types of days. And I'm doing it simply because the data seems to reflect that after big moves, especially to the downside, that is statistically speaking when you tend to see the highest probability of the market moving sideways. It's usually after those big moves that you see that consolidation. You were referring to consolidation before. And one of the things that we spent a lot of time looking at is, when do markets consolidate? And we seem to find, at least from our research, that markets tend to consolidate after big moves, meaning the market needs to digest the news, if you will, that caused the big moves yesterday. And during that digestion, there's a lot of back and forth between buyers and sellers that tend to create those sideways range bound markets. So I perhaps I'm in the minority here, but I will say that big days like yesterday are when you see that explosion in implied volatility really provide, in my opinion, the best environments to take on some of the more riskier strategies. And for those of you that perhaps may not be interested in selling option strategies with unlimited risk, you can potentially cap your risk by turning those things into iron condors.
Mm-hmm.
So let's discuss a little bit about kind of, the pros and cons of shorter dated options, right? So let's talk through some of the strategies that you could potentially trade. Now, I think maybe the best thing to do is to start off with some of the more traditional strategies, like such as just buying a call or a put. We've seen these massive moves, even in the equity markets, but certainly in the single stock names, where you see a big move, somewhere in the 5, 10, sometimes even 20% move, like we saw in Target yesterday.
Mm-hmm.
What are the advantages of using a short dated option to take advantage of some of those directional moves? And what do you see as some of the risks in doing so?
Yeah, so there is an advantage if it's shorter dated. You are going to have an accelerated theta decay, but as long as you are completely aware of that and capitalize on that and choose your strikes and expirations accordingly, that shouldn't go against you. You do have a higher gamma, but that's good. So you want that for something that you're going to go long, suppose. So if there is an acceleration like there was in this security, and if you actually look at the earnings for Target and things that they said, a lot of analysts actually still reiterated buys for these securities. And so those are things that I would take it into account as well if I was going to go long a position or what my thought was on it. But no, that could be a longer term type of thing. But there is risk in shorter dated options because you do need a movement higher or lower. But if there is those emotional traders come in and they say, oh, Target didn't do what I intended for it to do, or I see that things are really bad, then there's this acceleration of selling and you want to make sure you find that support zone, then you could capitalize on that from a short-term perspective, utilizing something with a super high gamma that you can capitalize on that acceleration is the way that I would, I'm going to use the word play short dated options because that's essentially what it is.
Yeah. And I think a lot of viewers here today have taken shorter term views in the market, especially in the markets that we're in today, where markets are up 3% one day, down 3% the next day. You really have to be nimble. You really have to be potentially in and out same day, right? And just some of the ways that you can play that is to use a shorter dated option. There's no doubt about that. But I think it's important just to understand what the potential rewards are when you do that, but also more importantly, what are the potential risks? It's not to say that these risks are not worth it. It's just important to understand both. And I think let's just use Target as an example. Down 25% yesterday, down another 5% today. I do think further downside from here is somewhat unlikely. I think you're going to see more of that consolidation, but I'm just going to use this as an example, not because I think Target is going to move substantially lower. And actually, perhaps let's do this. Let's actually use Apple as an example, because I actually think Apple has a very similar setup right now to what we saw in Target and Costco before the sell-off here, right? If you look at a chart here for Apple, let's zoom out a little. I'm going to get rid of the Ichimoku cloud just for a second. What you see here on Apple is that it recently is breaking down below a fairly significant support level here. We're trading at about 140 or so. Today, we closed below this support level. And this really starts to target some significant moves here to the downside, right? This is the same setup we saw in Target and Costco before the move yesterday. So I'm going to use Apple here for an example because I purchased some puts here on Apple the other day. I didn't go short dated as perhaps some investors are doing. I went out about 30 days at the time. But let's take a look at the difference between buying, let's say, a 30-day put versus buying in this particular case, an 8-day put. I'm going to use the 135 strike, for example, slightly out of the money. Buying a May 27th 135 put will cost you $2.55. This is an option that expires in just 8 days versus buying a June 17th 135 put that expires in 29 days. It will cost me roughly double that. But notice how I do get time exposure that is more than roughly 4 times the amount of time exposure for twice the premium. That's one thing to really be aware of, is that as you go further out in time, I'm getting 4 times the time exposure, but I'm only paying twice the amount of premium. That is something to consider. And what I'm going to do is, let's say I assume that between now and let's call it Monday, the 23rd, right? Which is just 2 more days of trading, May 23rd. The stock's currently trading at 137.35. I do think that if things start to fall apart here for Apple, they'll probably unravel pretty quickly, maybe down to the 130 level here. And that's really how you can use the OptionsPlay tool to see, well, okay, if I bought this really short dated option, the May 27th 135s, that's going to generate $290 in profit, which is 114% return, versus the 30-day option, which will generate roughly the same amount of dollar profit. But as you can see, because I paid twice as much in premium, my return is significantly less at 62%. And I think for a lot of traders that are looking for that leverage, and you're referring to gamma, this is really where that shorter dated options give you that acceleration in leverage, that gamma exposure that you get with the short dated option that you're just not going to get as much with that longer dated option. So hopefully this shows you a little bit as far as the difference between buying a shorter dated option versus a longer dated option. And this is kind of the positive side, right? Let's talk a little bit about the risks. And because very well, what could happen is that the markets kind of stay flat here over the next couple of days. Maybe the market digests a little bit of what's happening over the past couple of days, and the market doesn't move very much, and the stock stays around 137.5. As you can see here, the longer dated option, I only lose 15% of the premium that I pay. Versus the shorter dated option, I lose more than 50% of the premium that I paid in just 2 trading days. That's how extreme these short dated options are affected by time. So Jess referred to time decay, and this is really one of the most critical, this is probably the most critical piece to understand about the risk that you're taking with a shorter dated option, is that what you're paying is going to evaporate in value very, very quickly if the stock doesn't move in the direction that you expect it to. Even over a couple of trading days, you can see the vast majority of the premium that you pay effectively evaporate to theta, and vice versa. If let's say you're flat out wrong on the directional view and the stock takes even just a few dollars move here to the upside, maybe back into that 141 range, this is really where you lose effectively 100% of the premium that you paid, 85% of the premium, versus here, I lose 41% of the premium that I paid. I could simply get out and still claim back close to 50% of the premium I pay and move on to the next trade and place another trade. But that's really kind of the risk to reward ratio of shorter dated options versus longer dated options. And Jess, I don't know if you have anything that you want to add to that with respect to these shorter dated versus longer dated options.
Yeah, I think this is where you may adjust best practices for the deltas that you choose, right?
Yeah.
And this is where I really like spreads as well. If I'm going to be shorter dated, perhaps I cap my upwards potential or downwards potential, or mitigate risk. However it is, I think that's extremely helpful with shorter dated options, and something I even traded yesterday, just because it takes time almost out of the equation. You can sell and cap your upwards potential for the call, and then give yourself a relatively low theta. And that's something that I think is important when you're trading shorter dated options, because your biggest risk is high theta. And if you guys didn't attend the Greeks webinar that we did a couple of weeks ago, and Tony did a great job explaining it, but the high theta is centered on front month options and around at the money options. So it's higher. You have a higher acceleration of losing the value of that option the closer it is to expiration and the closer it is to the money. So with that in mind, if you can offset that with a short position, and then perhaps adjust your deltas as well to not be maybe just a tiny bit in the money, so not as close to the money, that could help mitigate that theta decay. So that's the only thing I would add to that, to maybe if I was trading shorter date options, that I'd have to be super, super aware of, because you're increasing the risk, which means you have to increase your knowledge base.
Right. And thank you so much for suggesting the spread part, right? And this first part was just to cover the basics of kind of using a single leg. And I'm glad you brought up spreads, because spreads is a big part of what we do here at OptionsPlay. It can provide a lot of the best of both worlds, if you will, right? If you're only buying options or if you're only selling options, you kind of have one or the other, right? But spreads can provide you with a little bit of a benefit on both sides. So I think a debit spread is actually a good example here of how you can take a directional view with a shorter dated option, but do so in a way that helps mitigate some of the concerns that, or some of the risks that I refer to, specifically time decay, right? So if I use a debit spread, so Apple's trading at 135. If I use a 140, 135 debit spread, as you can see, the cost of the trade between the spread versus the long put is very similar, 232 versus 255. But in the scenario where I showed you, where if the stock doesn't move between now and Monday, the short dated put that I purchased would lose roughly half the value that I've paid for, because that time decay evaporates. But as you can see, if I traded the debit spread, I actually see a small gain. This is one of those weird scenarios where even on a debit spread, you actually have a short theta position where you actually have a time decay working in your favor. Not a whole lot, but it certainly is not working against you. And that is one particularly interesting way to play this, because the risks are still the same, because if the stock starts to move against you, you actually see a risk profile very similar to being along the longer dated option, right? I'm losing roughly, in this particular case, 41% of the premium I pay versus nearly 90% of the premium that I pay. And then if I am right, I do lose some of the upside, if you will. So as the stock moves down, let's say it moves down to 135, as you can see here, I don't see the same return as I do. So actually, let's say we look at 130s. As you can see, I give up a little bit of the upside here. Instead of making 114% return, I'm only making a 98% return. But I've significantly reduced my risk, and I've mitigated, if you will, the time decay factor. So from my perspective, I would much rather give up an additional 10, 15% in upside, but mitigate my downside exposure and mitigate kind of my theta exposure. And this is really kind of where the power of spreads is really useful. And you can use the OptionsPlay tool to analyze and set up these types of trades and potentially understand them better before you execute them in your platform. And what you can do also, for those of you that are new to OptionsPlay, is you can paper trade these. You can click on the trade button, and you can use our paper trading feature. You can create as many portfolios you want. You can use them to track your live portfolios. You can create a paper trading portfolio, and you simply add the position to your paper trading portfolio, and that will track it using our portfolio tool. And you'll be able to see those positions and see how the P&L changes over time as the stock goes in your favor, as it goes against you, and be able to look at those trades. So as you can see, this 140, 135 put vertical that I just created here on the on Apple, you can see that, and I can track my my P&L of this particular trade as time goes by. So this is really something that's I would say, a very powerful part of OptionsPlay that allows you to take what you're learning here today and implement them and analyze them, make sure you understand your risk before you place those trades. So, we're going to do more of this, talking a little bit about these shorter dated options and just the type of strategies that you can do. Jess, any other type of shorter dated option strategies that you might want to cover and take a look at here today?
I think we've really adequately covered the long side of it. Dorothy asked a great question. That's a good transition into the short side of it. So buying the Apple put, but selling something in order to pay for it. So if you sell something at a higher strike, that's going to be more valuable, which means you're going to turn it into a completely different strategy, which is a credit spread. So in which case I'm going to want to retain that credit. So if I wanted to sell something in order to pay for that put, if I'm bearish, it needs to be at a lower strike. So that's important to know there. But on the credit side, and the way that I would adjust for this is looking at implied volatility. So if there is an excessively high implied volatility rank, perhaps I would choose a credit spread, or not perhaps, I would choose a credit spread at that in that case and have something driving that is short, because now I can capitalize on that volatility crush, which is what I was talking about earlier. And that's actually my deciding factor, whether it's short dated or longer dated. If I'm going to have something driving that is long versus short, is what's the implied volatility look like? Is this too expensive? If it's too expensive, I'm going to sell it. If it seems cheaper, then I'm going to buy it.
So I'm going to offer a bit of dissent here on the IV rank and using that as a selection for strategies. This is one of my biggest, I would say, bones that I want to pick with Tom Sosnoff. And both of us have spent a lot of time learning from Tom and learned a lot from him. But the one thing I will say about, calculating IV rank is only looking at 30-day volatility, right? So what we're only looking at is how has the 30-day volatility, what is the 30-day volatility today versus what 30-day volatilities look like over the past year or so. And it only looks at mostly the at-the-money options. And when you're trading a spread, what you're really doing is you're kind of trading two options, right? You're trading an at-the-money or an option that's close to the at-the-money, and then you're trading an option that's further out of the money. And what you're really trading is actually the spread between the two, especially on a credit spread. What you're trying to do is you're trying to find options that are at the money that have elevated implied volatility, and you're trying to find out of the money options that are relatively cheap and relative from a volatility perspective. And IV rank simply does not give you enough information on that front. It's just it's really just a 30-day at the money volatility. So I will say that while IV rank has a good relationship to, when IV rank is high, you want to sell. When IV rank is low, you want to buy. I do want to caveat that, it's not quite enough. It is a good starting point, but it's not quite enough. And I'm glad that you brought that up. And if someone's asking about, assignment concerns on weekly credit spreads, I do want to address that. But let's talk a little bit about credit spreads here. Before we jump into the specific credit spread, I do want to point out, if you are looking for credit spreads, you can click on the high implied volatility button here. High implied volatility button here on the trading tab in OptionsPlay, and we will default to a put credit spread and a call credit spread as a starting point to provide you with both a bullish and a bearish credit spread that is already optimized based on our algorithms. Now, what we're going to do today is we're going to change them, and we're going to look at a shorter dated credit spread and compare them to a longer dated credit spread. So let's look at a short call vertical here. Here we're looking at the July 140 150s on Apple. I'm gonna change this up, and let's go out to a shorter dated one, maybe a May 27th, and we'll look at selling, let's say, the 138 143. So roughly $5 wide here, both $5 wide. One is obviously longer dated. You're going to collect $3.38. Oh, I'm sorry. This is $10 wide. So let's change this so that it's $5 wide. This is the 140 145s. This is the 138 143s. As you can see, the two collect roughly the same amount of premium here, $183 versus $185. One is a 1 week credit spread, and one is a 45-day credit spread. So risk to reward here is virtually the same. The amount of premium that you're collecting versus the amount of risk that you're taking, and the probability of profit is also very similar. So this is really where it's important to understand kind of the differences between the two strategies. Really, what the biggest concern that I have with these shorter dated options is that, yes, the shorter dated options have a high amount of theta. So you're going to capture a premium very quickly each day that goes by. But there is a downside to it, and that's gamma. Gamma is very high for these shorter dated options, and that works against you. What do I mean by that? Is that if everything stays where it is, right? Apple stays around 137. Each day that that goes by, as you can see, your profit adds up very quickly on the shorter dated option versus the longer dated option. But even a small move in the directional view against you, you're going to see a much larger loss in your shorter dated option than you do in your longer dated option. So if the markets start to move a little bit higher, you're going to see almost 100% loss on your short dated credit spread versus the long dated credit spread. You have more time, you have a little bit more wiggle room, and those losses are not as severe in the short run, even for a small move. And we see in this volatile market, things can move very quickly. Apple could be at 145 next week very easily. And if that was to happen, you would lose virtually 100% of the premium that you collect. Or I'm sorry, twice the premium that you collected on the short dated credit spread versus the longer dated credit spread. So those are the two forces that are really important to understand when you're comparing short dated versus longer dated credit spreads, is the acceleration in theta versus the gamma risk that you're taking. So Jess, I want to address Joe's question about assignment concerns when you're selling weekly credit spreads. Why don't you jump in and kind of discuss a little bit about that?
Yeah, it's high because of that theta decay. So if it's even in the money and doesn't have any extrinsic value at all, which could happen if it moves against you, in which case you're very likely to get assigned early. I actually was assigned early this morning on one of my positions, to my surprise, and it was for that reason. It moved against me, therefore extrinsic value was completely depleted. And I was assigned early, which is a high probability because it makes sense for that person who exercised those puts to do that, because there was no extrinsic value in the option. So the risk is accelerated when you hold an option that week of expiration. And that's regardless if you're trading short dated or not. It's just when you hold it to that time frame. And then if you enter into that time frame, it's just how you have assignment risk that entire time.
Yeah. There's no way around the early assignment risk and just the elevated risk that you're taking with these shorter dated credit spreads. You kind of have to hold them closer to expiration, and as closer you get to expiration, the higher the risk that you have here. And this is why when we backtest the strategy over long periods of time, not just during the kind of the volatile market periods that we're in right now, the ideal credit spread is to sell them roughly 45 days to expiration and actually start rolling them about 2 to 3 weeks from expiry, because that reduces early assignment risk, or it almost eliminates assignment risk. It doesn't eliminate it entirely, but you will very, very rarely see an early assignment 3 weeks before expiration, even if it's fairly deep in the money. So those are some of the things that you want to be careful of when you're selling these shorter dated options. So we're not here to say good or bad. We're here just to discuss what the risks are, what the pros are, and kind of what you have to be aware of if you are going to trade these short dated options, because it's clear to us that many of you viewing this today are trading these short dated options. And actually, why don't we just kind of ask the audience here, how many of you have traded options that expire in less than 10 days over the past few months? Type 1 if you have, and type 2 if you have not touched options that expire less than 10 days. I see almost all ones. See some twos. And I think for those of you that traded twos, you might find yourself navigating this market a little easier. For those of you who have traded ones, maybe you found some days with really high profits, but I also bet that you've seen some days where you've seen some pretty spectacular losses very, very quickly. So this is more of a risk tolerance preference thing, I would say, as to which one of those two that you might choose. Again, we're not saying one is better or worse. It's just a matter of your risk tolerance. And I think risk tolerance is something we're going to talk about here in a little bit. But let's shift gears a little bit here, Jess. Let's talk a little bit about the current markets. Because yesterday's decline in the retail space, led by Target's 25% decline, was, I would say, unnerving for most investors to see a name like Target, which has been a darling of the retail space for quite some time throughout the pandemic, to be down 25% in a single day. What's your take on that? And what do you do with a move like that in the retail space? Do you lean into it and search for opportunities? Do you stay away from it? Kind of what are you doing?
Yeah. So I want to take a step back on that question. So something that we haven't talked about, but Amazon doesn't report with retails. However, I don't know about you, I buy a lot of things off of Amazon. And so that's a good indication and it's a precursor really into the retail space. And Amazon had a similar decline. And so if there is a fall within Amazon, I actually expected that because of the Amazon space declining from their retail perspective as well. So that was my thoughts on the retail view. And then I was just looking for where it would find support from a macro perspective on the market overall. My other thought on that is a lot of forward earnings were shifted due to supply constraints and inflationary concerns raising prices and consumers not spending so much money. However, that was this time. Go back a couple quarters when there was an increase in spending and funds being pushed into consumers' pockets, forward earnings and forward lookings actually raised targets in spending. So I personally feel it might be a little bit of an equilibrium. We need some cooling off in order to help with those inflationary concerns. And part of that is the supply factor and less spending. So I think that could certainly be helpful. But I do think we all missed a lot if you didn't look at Amazon prior.
Yeah, and for those of you that did follow me, I think I put out an Amazon short right before earnings. This was based on, exactly what we saw from Target's earnings, the concerns about supply chain, concerns about wage inflation, and, just a bit of a slowdown in consumer spending, which we did see that. And I would say Amazon's move to the downside was obviously almost mild compared to what we've seen here in Target, right? That was just outright violent. And I'm sure a lot of people had some pretty big wounds to lick after yesterday. So, from my perspective, I'm glad Ellen's asking this question, what are your thoughts on Costco here? I think that you have to, when you look at a day like yesterday, I don't think it's time to look at names like Target as a buying opportunity. I think you need a little bit more time for the markets to digest what yesterday's report really means for the future of Target. I don't necessarily think that the future of Target is in jeopardy per se, but I do think that you need more time to look for that consolidation that Jess is referring to in a name like Target. But when you look at names like Costco, right? Costco was trading at fairly rich valuations prior to this particular sell-off. And I do think that you have to look at the business model of Costco, which is far more insulated from inflation. 85% of their revenue comes from memberships, not from selling goods, which is vastly different than any other retailer. There's no other retailer in that particular space like that. I think Amazon is similar from the perspective of, they generate quite a bit of revenue from Prime memberships rather than just selling goods. They have Azure Cloud. Amazon is a difficult beast to kind of wrap your head around because they have so many different business units, of which cloud is really one of the main drivers of revenue that flows into growth of other businesses. Now they have logistics, they have e-commerce, they have cloud. It's difficult to wrap your head around valuations for that. Versus Costco, it's very simple. It's memberships, it's reoccurring revenue. It's easy to apply a multiple to that and say, where should it trade from a multiple perspective? And I would just look at, where is Costco trading from a valuations perspective relative to history? I don't think it's quite cheap yet, but this is really where I do start thinking that if you missed out on the move on Costco, this is a potential opportunity to start looking for some opportunities. And I think this is a good time to shift to kind of, how do we look for opportunities here in this market, right? Because I certainly think that for a lot of investors, you're in two minds, right? Where are there further downside opportunities in this market like Target and Costco? Because I don't think we're done with moves like that in other areas of the market. And then at the same time, where do you find buying opportunities in the carnage, right? So, happy to share with you some of my thoughts on this, but, you've seen some of my thoughts on CNBC over the last few weeks. You've noticed that we've been bottom feeding ASHR, the Chinese A-shares ETF, ARK. Something that Rick put out here last Friday that I used on CNBC. This is something that I've purchased in my own portfolio because these are kind of these bombed out opportunities in the market that potentially may not be the exact bottom, but certainly warrant us a look at this point. But at the same time, I still think there are opportunities here to the downside, and those are ones that I'm buying some puts on. I want to discuss what those things are, but Jess, I'd like to hear your thoughts in terms of what views or what opportunities do you see in this volatility at the moment?
Yeah, I feel like I constantly say I take a step back, but I really do. And there is a good question from Ken as well that's really related about why inflation rise doesn't really worry people and through how it was in the 80s. So I actually like to take a look at the market as a whole through high inflationary periods and recession periods and see how stocks have reacted and survived, and then what contributed to that, and then apply those factors to my stock pick. So it's a little bit of a fundamental approach. I utilize that to screen, and then I validate my views with technical analysis, because I do also love technical analysis. I think it's great to absolutely have a balance. So for example, there was a really great study I read where you look through recessionary periods and go back to the foundational aspects of what is the market. So the Dow is literally 30 securities, the S&P is 500, the NASDAQ's tech heavy securities. So they're just stocks, right? And if stocks have really good earnings per share and they adjust, they grow. And so what I'm looking for is stocks that have healthy fundamental data, so good earnings per share, that how they've reacted throughout previous recessionary periods. Not saying that we're in one right now, so we're certainly not, but from January to now versus those other recessionary periods, how are their earnings per share prior, during, and after, and the peak and trough of those securities throughout? And then I'll look for something similar, so that I'm finding securities that are just healthy from a fundamental perspective, because historically they really rally when it comes out of those type of periods. What I find is really interesting is going through that study and trying to figure that out, is even though they're healthy securities, they still went down with the market, and they still contributed to those emotional downward sells. So I think that's important to note as well when trying to find opportunities in that type of market, and why technical analysis is also important as well in finding those areas of supply and demand. That's extremely important in those type of scenarios. So I'm looking for securities that fit health, and that's one component of it. And then the others are just knowing those environments. So anything that has anything that's out of our regulations control, like supply constraints and companies that aren't heavily impacted by that, that's also something that would be a good pick as well. So that's why I picked TMO last week. It was biotechnology. It offers growth and innovation like the technology sector, but since it has that healthcare aspect, it doesn't have it's better suited for the macro environment because it doesn't have too many inflationary concerns or supply chain constraints. Therefore, that's why it has been outperforming the S&P 500 and why that was one of my picks. So I would also, look at the fundamentals very heavily on that, make sure revenue was good, make sure net profit was there, earnings per share was growing, and then I would also compare that technically, and that's how I chose that buy. So a lot of factors go into it right now.
Well, I like that, right? Because this is really kind of why we're doing this show, is so that we can talk through kind of our thought process, right? On CNBC, I don't get much time. I get literally 90 seconds to lay out a trade idea. I have to talk through the chart. I have to talk through the fundamentals, the story, and lay out an options trade in 90 seconds. It's not easy to do. So here you get a bit more discussion back and forth between Jess and I as to how we screen for these stocks, how we look at the technicals and fundamentals to look for opportunities. And Thermo Fisher, interesting you bring up, healthcare, right? This is really one of the spaces where we've seen an incredible amount of outperformance relative to the market, as certainly outperformance on the downside as markets corrected. Healthcare did not correct as much. We actually saw many healthcare names like United Health reach new all-time highs as the market was selling off, because they are insulated to these inflationary concerns and the slowdown, if you will, from a consumer and a spending perspective. So that is very interesting. So on a trade like Thermo Fisher that has pulled back to this let's call it the 515 support level, right? It's held this level multiple times. And this is a bit of a contrarian view, I would say, in the broader markets, because this is a stock that is exhibiting bearish trends. It's trading near relative lows. What's your option strategy to trade something like Thermo Fisher?
Yeah. So I would choose two here. And this is where I would use the OptionsPlay tool. And I would compare them. So I would either do a bull call spread or a bull put spread. And it's just, do I want to achieve that credit at that time? And I'm going to look at risk and reward. That's literally what I would do in this case. Yesterday, because it was down, I did sell a bull put spread.
So a bull put spread, if you're looking at right now, using the high implied volatility feature in OptionsPlay, it selects a bull put spread here for you, which goes out to the July 15th expiration. That's roughly 45 days from expiration now. And it's looking at selling the 550, 510 put vertical. And as you can see, that's going to collect right now $1,100 in premium for a $2,800 risk. I will say for me, that's a little bit too much risk for the potential reward. Even if you get filled at the midpoint, that's going to be a little bit better here. You're collecting exactly roughly 1/3 of the vertical width. So $13.60 on a $40 wide debit, a $40 wide credit spread is almost exactly 1/3 of the vertical width. So this is kind of the bare minimum that I typically look for on a trade like something like this. So that's just an example of a trade that you can potentially make. And you can make an adjustment if you are trading this. If let's say you want to adjust to a shorter dated option, then Thermo Fisher is, while liquid, doesn't list weekly options. It's just kind of odd from the perspective of this is a fairly widely tracked and held stock that trades today 2 million shares on a $500 stock. That's a fair amount of turnover, yet it doesn't list options. So it doesn't list weekly options. So you have a limited amount of choice between June and July options here for Thermo Fisher. But this is what you can use OptionsPlay to test out, and you can modify these strategies and compare, let's say, a long call vertical to a short put vertical, and be able to instantly put together these types of strategies and see which one perhaps might be best suited for you. And you can always paper trade them and make sure that you understand these trades before you place them. Now, one feature that I do want to talk about here, and this is so important in this volatile market, is really risk management, right? And maybe, for example, Thermo Fisher at a $550 stock may be outside of the range for some investors, where $2,700 worth of risk for a single contract is just too much. So one of the things that I do want to highlight for traders who are watching this here today is that when you go into your profile, and I recommend everyone who's watching here today to go into your profile and go to risk and income settings, which is the last button here on the left-hand side. There are two inputs that you need to put into the portfolio risk contract calculator, which is how much are you willing to risk of your portfolio as a percentage basis, and what is the value of your portfolio. I have this set to 2% of a $100,000 theoretical portfolio. So you can go in, you can set them. I recommend that you start with somewhere around 2% in terms of what you're willing to risk per trade. And all you have to do is put in the dollar amount that your portfolio represents. And when you save this feature as default, when you're using the application and you click on the risk and investment calculator, you should be doing this on every single trade that you make. When you click on this, and you click on the calculate button, it will calculate the number of contracts that you can buy or sell. In this particular case, you actually, in theory, should not be trading this at all, because the max risk actually exceeds $2,000. So what I'm going to use, I'm going to go back to my Apple example. I'm going to use Apple as my example. Let's say I want to buy a shorter dated put option on Apple, because I'm concerned that Apple has fallen through support. And I'm concerned that they're going to follow through the same problems that Costco and Target is going through and Amazon's going through right now. They certainly, while maybe more immune than some of the other retailers, I don't think they're fully insulated by any means. And the stock price hasn't reflected, what we've seen in terms of the downside on these retailers. So for me, I'm looking at buying some put options. I've actually purchased some put options in my portfolio. But to help me determine how many contracts I want to trade, I always use the risk and investment calculator. And our new feature makes it so that you just have to click once and it will calculate for you the number of contracts that you can trade. So in this case, when I clicked on the calculate button, it calculates that I can trade 2 contracts of the June 140 puts, because that total trade risk was $1,450. That is the maximum that I can risk and stay within my risk tolerances. It's so important for you to utilize this feature and make sure that you stay within your risk tolerances, especially in this volatile market. You should never be in a position where you find yourself having lost too big on a particular trade, because you should never risk too big on a specific trade. And this helps you stay in line with that. So it's really important that you understand that this feature exists and you should be using it on every single one of your trades. And how many of you have used that feature? Please type yes into the chat window if you have used the risk and investment calculator. And please type no if you have not used that feature yet. I see a lot of yeses, quite a few no's. So for those of you that have responded no, I encourage you right now, go into your profile, put in the setting. It takes 30 seconds to set your settings. And every single time you place your trade, you can click on the calculate button and will instantly calculate the number of contracts that you should trade on that particular trade. Okay, Jess, any other thoughts and views on the market that you currently are looking at? I have a few more that I can share, but anything else that you want to, opportunities, if you will, that you see in this broader market right now?
I think it's just knowing the dates when things will happen is extremely important. So knowing your economic calendar, when CPI is going to come out, when the Fed is going to speak, capitalize on those areas when you know the market isn't going to be moving that much until that happens. Exit your positions prior. If you do want to capitalize on those movements, just be very cognizant of that there's increased risk there. That's something that I would certainly take into account.
Okay. Thank you so much in sharing that. The economic calendar is, from a macro perspective, extremely important. And it's important to know, like, throughout the month, what are the important economic indicators that come out, whether that's GDP, whether that's Fed related, whether that's jobs related. I would say jobs, retail, Fed, those are the dominant ones to really pay attention to these days. Know what time of the month those things come out is important, because that's going to help you stay out of potentially some volatile overnight markets. Job report comes out at 8:30 a.m. first Friday of every single month, right? You may not want to be exposed too much overnight on some of those, especially if you're trading these shorter dated options where the premiums can evaporate very quickly. So very, very important thing, Jess. Thank you so much for sharing that. I'll say another thing that I've been looking at here is really Alphabet. Alphabet is also another one that has held up pretty well here in this market. But we're starting to see some concerns about regulatory concerns, and I really think that this is one that's another that could be one of those outliers where we start to see some movements here to the downside. Alphabet has already broken that 2,500 support level. It's been kind of consolidating below that. But this is really where I could see some further substantial downside, especially if their advertisement business, is really here, in jeopardy. And if you look at a chart here for Alphabet, I would say that you see a bit of a head and shoulders pattern that really is emerging here on a longer term scale. So, with that covers what I wanted to share with you here today. Jess, any last words before we sign off for today?
I think we covered it. Feedback's going to be really essential. Tony and I tried something new. So if there's something that you want to see different, I was also, we definitely talked about things together. We tried to have it more conversational, because we have these conversations all the time and we want to make sure we involve everyone, especially with these type of markets. So please give us feedback and what you didn't like, what you do like. That way we can make sure that we provide the best experience for you. And we do have different approaches. And I think that's why, that's honestly why Tony and I became friends 6 years ago, is we had an argument over Gamma. So I think that's good to know. So please, just let us know. Feedback's essential. And thank you guys for being such a great group.
Yeah, thank you so much for joining us this afternoon. Again, we hope that this is helpful in giving you a healthy debate on what's currently going on at the market and how to view this volatility, and just different viewpoints to provide you with some thoughts as to how you can approach these volatile times. We know it's difficult, but hopefully this gives you some ideas to look at and some ways to think about the broader markets. So with that, thank you so much. As Jess said, please send us your feedback. Let us know what you think, what you like, what you don't like. We'd love to hear from you and continue on this path and provide you with what you guys want to learn more about. So thank you so much and have a great afternoon.
Thank you, everyone.